Hey there, I'm James, and in this video I'll explain how operating profit margin works with an example. Operating profit margin, or operating margin, is operating profit divided by revenue. It's another profitability ratio similar to gross profit margin, which we covered in my last video. This one measures a business's ability to generate operating profit from each unit of revenue earned. If we multiply it by 100, then we can express it as a percentage. So how does operating profit margin work? We'll begin with profit. Profit is the financial gain generated in a business when its revenues are bigger than its expenses. In a basic income statement like this one, we can find it sitting at the bottom. Okay, but what about operating profit? This basic income statement only has one line for expenses. If we want to look at it in more detail, then we can expand it out. First, we take away the direct cost of sales or cost of goods sold. These are the variable expenses that are directly involved in producing products. That gets us to gross profit, the big profit. And below that, we subtract all of the business's operating expenses. These are the ongoing day-to-day costs involved in running a business. Things like research and development, selling, general, admin expenses, depreciation, and amortization. This is where operating profit comes in. It's the financial gain left in the business after deducting all the direct cost of sales and operating expenses. Below that, we also remove interest and tax, which is why operating profit is sometimes called earnings before interest and tax, or EBIT for short. But we'll go with operating profit. On the bottom line, we're left with net profit, which we'll get onto next time, so click subscribe if you'd like to watch that. You can find all of these videos in my financial ratios playlist, which I'll link to in the description. So one more time, what is operating profit margin? Operating profit margin is a business's operating profit divided by its revenue. And by the way, you can find this formula on my profitability ratios cheat sheet, which you can find in the description as well. It measures how much operating profit they're able to generate for each dollar of revenue earned. It only accounts for the business's direct cost of sales and operating expenses. It ignores the interest and tax expenses, which we can see further down the income statement. Great, so let's do an example. Here's the income statement for a business called MAD, a tech company that makes semiconductor products. It summarizes the revenue they earned and the expenses they incurred over a 1-year period. But what is MAD's operating profit margin? Well, we can see that they earned revenue of $1 billion, and after subtracting their cost of sales and operating expenses, they were left with an operating profit of $150 million. So their operating profit margin is $150 million in operating profit divided by $1 billion in revenue. That's 15 cents of operating profit generated for each dollar earned, or 15% when we times it by 100. Very nice. But whilst it's helpful for us to know this number, operating profit margin becomes more valuable when we make comparisons. For example, we can compare it year on year. Here are MAD's income statements for the past 2 years. In the current year, they generated $150 million in operating profit with an operating margin of 15%. But in the previous year, they only managed an operating profit of $70 million. When we divide that by their revenue of $700 million, we can see that their operating profit margin was 10%. So overall, that's a 5% increase in operating profit margin year on year, which is not bad at all. We can also compare operating profit margin against similar businesses. This time we've got the current year income statements for MAD and Inlet, two competitors in the same industry. Inlet is the market leader in semiconductor products, and they earned a whopping $7.8 billion in revenue, and their operating profit was $2.34 billion. 2.34 divided by 7.8 is 0.3 or 30%. So not only is Inlet earning more revenue than MAD, they're also converting each dollar of that revenue into operating profit more efficiently. What causes a decrease in operating profit margin? Warning! I'm going to do a little bit of maths here to help explain this. Operating profit margin is operating profit divided by revenue. We saw earlier that operating profit is the same as gross profit minus operating expenses. Now if we separate this into two fractions and divide gross profit by revenue, then operating profit margin is equal to gross profit margin minus operating expenses divided by revenue. How does this help us? Well, it shows us that there are two ways that operating profit margin can decrease. Either the gross profit margin has gone down for all of the reasons that I mentioned last time in the gross profit margin video, or operating expenses have increased as a proportion of revenue. Perhaps they're spending more on research and development or administrative expenses, or maybe the business has been selling their products or services at a discount. On the other hand, what causes an increase in operating profit margin? We've still got the same formula, but the arrows are flipped around. Gross profit margin could have gone up, which would have a knock-on effect on operating profit margin, or the business's operating expenses have decreased relative to the revenue it earned. It could have hiked the prices on its products or services, or it could have reduced its operating expenses through better cost management. As always, a big thanks to all my channel members. Your donations help me make these accounting tutorials, so I value your support. Stay safe, and I'll see you next time.